Carvana is up 700% year to date. Not in the last 5 years, not in the last 3, not in the last 1 year, year to date. This stock went from an all-time high of $376 on August 10th, 2021, less than 2 years ago, down to a low of $3.55 back in December, just 8 months ago. And now it's sitting at $37. So the question, Mo, is Carvana back?
Has to be, right?
So I see a lot on Twitter. People are saying, well, this is the obvious thing. Carvana is this great company and it's now being recognized. Guys, a prime example of the news following the stock price, right? Because this stock was a $5 stock, $3 stock just 7-8 months ago. And now where is it?
Is this company, like, are they still like selling cars and stuff?
Yes.
Because the vending machine that I drove by recently didn't have anything in it.
Are you kidding? The one over on in Warrensville?
Yeah.
They had cars in there.
Oh, they're back in there? Because they were like empty. And then when I drove to Nashville, there was one that didn't have any cars in it.
Oh, no,
I was like, oh, do they go under? And now you said we're doing this video today. I'm like, wait, what?
Oh, no, they're still going, guys.
Okay.
This is still a...
thriving company?
I don't know about thriving, but we're going to look at it. And the other thing I'm going to do is I'm going to compare it to 2 other car companies that sell cars, right? 2 other dealership groups. Because I think it's a fair thing when you have a company that loses money like Carvana to sit there and say, okay, what is its potential and how are they making money on every individual car before paying for overhead? So guys, in this video, I want you to stay the entire time. We're going to have things for beginner investors. We're going to have things for more advanced investors. But the key to our videos is this. We want you to look at buying a stock as buying a piece of a business. Of course, the volatility in the markets makes you get emotional up and down. I get the same way. Don't think I'm immune to emotion. I get the exact same way. I get upset when I see my stocks go the wrong way or my investments go the wrong way. But the key is, if you have a good process, which is what we're trying to teach here, a good process will, in the long run, lead you to good results. What are those good results? I don't know. Hopefully beating the market by some sort of amount. How much? I have no idea. It probably depends on how much of the details you want to get. So, again, stay the entire video. We're going to go over our 8 pillars, analyst estimates. We're going to try to do a stock analyzer tool on this company to sit there and see, based on our assumptions about the future, what price we should pay for the company today. But let's start with some high-level items on Carvana. First off, it's basically a $4 billion company. $4 billion market cap. Revenue last year of $12.7 billion. Now, here's the interesting part, Mo. Net income last year, they lost $1.5 billion. Mm-hmm. Free cash flow last year, they lost $1.1 billion. Mm-hmm. Oh boy. Gross profit, 10.1%. Now guys, this is something I want to focus on for this company. Gross profit means basically for every car they sell, they make 10% of that car. So they sell a car for $30,000, they make $3,000 on it. And from there, they can use that $3,000 to pay for overhead costs and their income taxes. Okay? Now, I pulled up 2 car companies. AutoNation and ABG Group. The reason I brought these 2 car companies out is I Googled, okay, what dealerships are like this? AutoNation's a very popular dealership. Asbury is the other one. Look at AutoNation's gross profit. 19.7%. Oh yeah, CarMax
9.8%.
Okay, so just in line with, but look at, okay, so they're just.
But then you look at other metrics and they're much different.
So CarMax has a very similar gross margin.
Yeah.
But look at AutoNation.
Yeah, it's big.
19.7%. Okay, let's look at Asbury Group, Automotive Group. 19.9%. Okay. So I'm looking at this thinking, okay, I like this, the fact that you pull up CarMax.
Yeah.
So they did $28 billion in revenue, over double what Carvana has done. But they're making money.
They are making money.
Their 5-year average profit margin is 3.4%. Mm-hmm. And their 1 year is 1.6. But they have negative free cash flow, and the 5-year average free cash flow is negative as well. Right. But you look at a company like Asbury, look at this, Mo. 5-year average, $530 million on a $5.5 billion market cap. And let's look at AutoNation. $8.4 billion market cap and a 5-year average free cash flow of $950 million. This is in single digits, 5-year free cash flow.
Yeah.
So guys, first thing I'm going to do is say, okay, can Carvana even be like CarMax, where they can take this very low gross margin and convert it into a few percentage points, because the car business is not a lucrative business.
No, it's not.
Everybody thinks it's a super like high margin. It is not.
Right.
That's why whenever I hear, I once was on a trip with a friend and he bragged to me that he bought a $40,000 car for like $28,000. And I said, bullshit. He goes, no, it was a brand new car and they have all that profit in there. I go, lie. It was a Nissan. And I'm like, no. And finally, he confessed that it included his trade-in and all the rebates by the company. And I was like, okay,
well,
so
that makes sense.
Yes, now that makes sense that you paid $28,000 for the car.
Right.
The car business makes money basically off of service. That's where they make their money. I don't know what Carvana is going to do for service, because
I have no clue.
Do they have service?
I don't know.
In that little tower of theirs? I'm sure they do, because service is a very lucrative part for car dealerships.
Maybe it's in the basement of the vending machine and we don't know about it.
Listen, and this is part of the process of learning. We're doing this video with you as we learn about this company. So Mo's going to sit there and see, do they do any service?
No.
Why don't you check their 10K?
All I'm seeing is buying it. Sure, I can go to their 10K.
So that's part of the process here. So let me look at some other things. Let me look at their 8 pillars right now. Oh boy. Now guys, if you have our software, you can customize your 8 pillars up to 12 pillars, and there's like 4 quadrillion different variations. But I stick to our basic ones because I like them. Guys, we have 1 check mark. That's revenue growth. Now again though, oh my God, look at shares outstanding. 478% increase in the last 5 years. They are diluting the hell out of their investors. They're literally sitting there and saying, hey, thanks so much for investing. We're going to give you a ton more partners without you requesting it, and we're going to split the revenue and profit with them. That is diluting the heck out of you. There's not enough data for free cash flow. I mean, guys, this is just a mess of a company. Does that mean this company isn't going to do well? I don't know. But all I know is that if you're looking at a company with an income statement like this, they have yet to make money in any, let's go to their annual numbers here on their income statement. Full year annual. They have not made money in a single full January to December going back to 2014. How about cash flow? Let's look at their annual cash flow. Okay, so down here, guys, we have our free cash flow, which is cash from operations less your capital expenditures. Negative, 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 negative. Again, that could be because they were putting up a bunch of towers. They're putting up all their dealerships. Okay, fair enough. I can get behind that. But at some point, I want to be able to see how it leads to profitability. And my big concern here is, I know CarMax has a lower gross margin, but man, how do they make this happen? Does CarMax do service? I think CarMax does service. Do they?
That one I'm not. So Carvana sells extended warranties.
That's a very common thing.
Through drive time. That's who they use. But I'm not seeing them actually doing any physical
CarMax
service.
has service.
They do have a service department.
Yeah, but it's interesting because I would think their gross margin would be higher then.
Let's see here.
You know, a lot of dealerships, what their goal is to get you to just buy a car, and that way you come back to them for service. But that's usually in the new car area.
Right.
Because you have warranty work. You go back to the dealership and say, hey, give me this. It's covered by warranty. So they're happy to do that. I look at and by the way, Carvana, I've heard a lot of value investors back in the day loving Carvana.
Mm-hmm. Yeah.
But man, it is just a tough one for me. It is a very, very tough one for me. Let's look at analyst estimates.
Oh, man.
Do you see this?
Yeah.
Guys, analyst estimates, almost, okay, $7.60, $5.90, $4.30, $1.40 in loss. Finally, in 2027, analysts expect them to make $2 per share. So guys, along that way, how do you cover losses? There's 2 ways to cover losses. You take on more debt, or you take on more investors, and that's going to dilute people even more. So right here, we're talking about, let's do some calculation real quick according to analysts. 760 plus 580 is 1340, 1770, and let's just call that 50 cents gain. So $17 in losses per share. Mo, how many shares outstanding do they have?
Let's see right now. They have 106 million.
106 million. So 106 million shares times 17 equals $1.8 billion in losses that the analysts are expecting. How did I do that? I just took their analyst expectations of earnings per share, for the next 5 years and multiply it by number of shares outstanding. So they got to figure out a way to cover 1.8 billion. Remember, guys, if they have to issue more shares for that, you're being like diluted even more. Way, way more. Man, that's a tough one. Okay, let's do stock analyzer tool. And the reason I want to do stock analyzer tool here, Mo, I know you just gave a face. Why'd you give a face?
How?
Okay. So to get a really accurate assessment of Carvana, it is not possible with our stock analyzer tool right now. And the reason being is our stock analyzer tool is great for 95% of the companies out there, the ones that make money and you can sit there and put some assumption in there. However, with Carvana, the reason I want to use the stock analyzer tool is I want to say, let's say they were profitable today.
Has to be today.
Today. Because I want to see, are they even within the realm of, let's say, for example, the stock's at 36. Let's say we do stock analyzer tool and the middle number is 80. Well, then I'm like, well, wait a second. They could get there. Because if they're only going to lose $17 per share, 36 plus 17 is 53. Even if I get diluted by that, I'm still looking like there's some upside potential in there. But if I do my analysis today and I do profitability from day one today and it shows me the top price is 18, I know I just got to avoid it. Because I'm like, well, wait a second. Like, even at my best assumptions of profitability today and high assumptions, I still can't get there. That's the reason to use a stock analyzer tool. And that's the reason we made these tools. Mo and I use these tools every single day exclusively for our investing. It has all these tools right here. And the big key here, guys, is real estate calculator, as of right now, is included when you buy our software. In about a month or so, it's going to go to its own separate purchase. But everybody who buys it now, or everybody who has the software right now, will be grandfathered in, and the real estate calculator will be included. Guys, you also get the community of thousands of people getting very active, even more active as time goes on, talking about investing, because investing can be a lonely road. So go to everythingmoney.com, $1 per day. We're running a special, $7 for 7 days. Just try it out. $7 for 7 days. I assure you it'll change the way in which you view money, and you get all these tools.
Before we do stock analyzer, question for you.
Yeah, answer for you.
Would you be surprised if this company did not exist in 5 years?
No, I would not be surprised. That's a very, very good question.
Yeah.
So this is a question we ask a lot. This was given by our friend Gary. He once said it to me about Big Lots. And he said, would you be surprised if Big Lots wasn't around in 10 years? And I was like, well, I guess I wouldn't be. He's like, neither would I. It's a question to ask about, do you want to own the company?
Yeah.
So I look at Carvana and go, how do you, when you have losses like this for the next 4 or 5 years, you need a very liquid market in order to finance your losses or be able to raise capital for your losses, investors.
Right.
And if that goes away, what happens to the company? Either they have to be profitable day one, that very day, or they have to go under.
Yep. Bye-bye.
So this is a very risky proposition.
Yeah.
So I'm going to put a very, very high desired return in here. And you're going to be like, whoa, that's insane. But we'll do 2 different variations. So it's very important, guys, that as we go through the stock analyzer tool, I need you to stay through the entire video because we're going to do stock analyzer tool twice. Because I want to show you what it's worth today, assuming a market-based average, and what we need it to be based on our desired return. So, Mo, give me your revenue growth numbers.
How about 10, 15, and 20?
That's high.
Yeah.
Are we doing 10 years or 5 years? Let's do a 5 year.
Do 5 years.
We're going to do a 5 year
on
analysis.
my screen.
You can do 1 through 20.
Yeah.
Guys, but we're going to do 5 years.
All right. Profit margin.
margin.
Oh, boy. I don't know. 1, 4, and 7, maybe?
How about 2, 3.5, and 5? Mo, they can't get to 7
yeah.
because they have a 10% gross margin. Guys,
I almost wanted to go to 7 just to show how if they absolutely destroyed it.
Okay, let's go 2, 4, 6 then.
Okay.
So what we're doing here, guys, is we're going to a really high, remember, the gross margin, that means that every extra car they sell on that specific car, they're only making 10%. Then they got to pay overhead and income tax on that, and we're still putting on the high side 6%. That is not very realistic.
No, it's not.
Because even if they have no overhead, their taxes alone are going to be 35% of that.
Right.
They're going to go down to 6.5%. But it's just to show if we do these really high numbers, what it ends up being. And what about we do the same thing
Same thing there.
2, 4 for free cash flow. Now PE, Mo.
15, 17, 19.
Fine by me. Guys, PE is hard in this situation because they're already a pretty large company. They're already selling $13 billion worth of cars.
Right.
And CarMax, which is absolutely huge, sold $28 billion. So they're pretty good size. They don't have a high ROIC. Can they put more those towers up? Probably. But they still have to get the bottom line is this is all pure guesswork. Now, finally, for a desired return, guys, this is where we put margin of safety in. The market can get you 9 or 10% over long periods of time. So with all the risks here of potential bankruptcy and all the loss along the way and the dilution and the fact that we factored in profitability day one, what desired return do you want here?
Profitability, I would go 15, 20, and 25. But if I was actually going for an investment here, it would be higher than that.
Well, I agree with you 100%.
know what I mean?
Now, the reason I'm asking you guys to stick around is after we do this stock analyzer tool, I'm going to do a normal one where I put 10% in here just to show you, hey, assuming this company is a normal company and you're fine just making the market average, this is what it's worth. So right here, 15, 20, 25%, hit the analyze button. Holy shit.
Okay.
Wow.
Wow,
low price of 37, a high price of 137, a middle price of 83. But again, guys, remember,
profitability today.
that assumes profitability today and revenue growth of 10, 15, and 20%. 20% revenue growth for 5 years makes them bigger than CarMax. But the whole point is here, guys, if they can get, and also 6% profit margin.
Yes. Now be realistic.
Let's go back and be more realistic in all these aspects. Revenue growth. I'm going to do 3, 5, and 7. Profit margin. I'm going to do 2, 3. I'm going to do 1.5, 2.5, and 3.5. PE, I'm still fine with that.
Yeah, I agree.
I'm actually going to do another stock analyzer after this. So let's assume this, the more realistic expectation, but these high returns because there's still a big risk of bankruptcy here. Analyze button. Look how much that just dropped.
Yeah.
Big time. Big time. Now, 10% across the board if you just want to make the market return. So guys, this is basically a play on, do you think they're going to get the profitability? Because remember, this assumes profitability today, and even analysts aren't expecting them to make money for another 5 years.
Exactly.
So that's why I'm trying to do this video. I want you to see how stock analyzer can be used. So guys, go to everythingmoney.com, check it out, $7 for 7 days. You'll be glad you did. Thank you very much for your time.